Good morning, everyone. Welcome to the Genghis Weekly Investor Briefing. We're glad you could join us. Today is July 26th, the last Monday for July. I actually looked that up today because I was confused what date it was. As we were starting this webinar, I scheduled it on Facebook and realized that we're on episode 41. So I just wanted to give a quick congratulations to the research team for holding it down for so long. I feel like this has become a regular part of our Monday mornings, and I'm so glad that Wesley and Melody have been able to join Churchill. So that's super. We're also glad to see so many of you joining us week in, every single Monday between 9 and 10. We're glad that you actually are getting value from our interactive webinars. As usual, we're going to review last week's market performance, and then we're going to analyze the opportunities for this week. The opportunities are going to be in fixed income, that's in treasury bills and bonds, as well as the equities market. I know Wesley is raring to go to tell us about EABL, so I'm super stoked. Thanks to him, I know that the results are upcoming. As usual, the Genghis Weekly Investor Briefing is interactive, so please feel free to use the Q&A tab to send in your questions. And then after the presentation that the team is going to take us through, we'll be able to address each and every one of them to hopefully help you and guide you in the upcoming week. So I think we're ready to go. Over to the head of research, who is Churchill, and his team, Melody and Wesley. Thank you.
Thanks, Damaris. Good morning, everyone. So let me quickly share my screen. Okay, so as usual, we'll look at the macroeconomics and then look at the fixed income before my colleagues now discuss the opportunities in the equity space. So in terms of the calendar, this week is quite heavy. We have the CBK Monetary Policy Committee, which is scheduled to be held this Wednesday. Our expectation is that the central bank rate will be held steady at 7%. Looking at the environment where we are in, we are still not yet out of the COVID-19 pandemic. In fact, there's that risk of the fourth wave or even the new variants creeping in. So from that perspective, we still expect that there's that broad cautiousness in terms of the growth expectations for the year. And more so, a couple of weeks back, we saw the latest report by the IMF and also the World Bank, basically coming up with lower revisions in the 2021 GDP expectations for this year. IMF from 7.6% to 6.3%, and then World Bank from 6.6% to 4.5%. So ideally, there's that caution in terms of growth expectation. Inflation has been more or less anchored. So from that perspective, there's that element of, well, it's still within the target band that is between 2.5% to 7.5%. Private sector credit growth, the latest number we have for as at May, we did a quick math, it was at around 7.1%. The target by CBK in its latest monetary policy statement, they are targeting something in the order of 8.5% by the end of June. So we'll wait and see whether they were able to attain that target of 8.5% at the end of June. But nonetheless, private sector credit growth is still more or less subdued in the context of double-digit growth that was estimated. So from those perspectives, we are seeing that broadly the CBK MPC will retain the benchmark rate at 7%, which will be like the 8th consecutive retention at this particular rate. July inflation rates will be out by the end of this week. The prior number was at 6.3%, and in our expectations for this quarter, we expect that the inflation will still have an upward bias, basically from the prior 6.3%. We still expect that even this number that will be released this coming week will be either higher than the 6.3% or slightly lower. And the reason is, ideally, if you look at inflation, it's just a comparison of what was the CPI basket for this year, service a comparable month the previous year. And for last year, we saw that inflation was more or less coming down between April all the way to September. So from that perspective, and what people use a jargon name base effect, we expect that even inflation number for this month all the way to September will have some upward bias, but just basically because of the calculation of inflation print, whereby you're looking at the CPI index. CPI, this is consumer price index vis-a-vis for this month vis-a-vis comparable month last year. So from that perspective, the base effect, we expect that there will be an upward bias, but nonetheless, nothing threatening or flaring up above the 7.5% upper ceiling. The other issue that we had expected to be released even in last Friday's Kenya Gazette and even the previous Friday's Kenya Gazette, this is now the net revenue and expenditure, basically just giving us a data of breakdown of revenue for the last financial year, except appropriation in aid, and also how these monies were now disbursed to the ministries, departments, and agencies. Ideally, this report should be out by the 21st of in any given month. So it's just some delay whatsoever for the publishing of this particular data. So this is the last Friday this month. So no, I think it goes without saying that it should be released in this particular Kenya Gazette issue for the statistics for the previous financial year. So that marks our expectations for the macroeconomic indicators this week. So we now move to the fixed income, just a review for last week before we get into the outlook or our trade recommendation for the week. So in terms of review, last week's secondary market activity declined. It's not an increase, it's actually a decline of 27.6% on a week-on-week basis to a turnover of 17.7 billion. What we've seen also continued playing out in last week's activity, whereby interest has been on the infrastructure bonds, IFBs, and also the short to medium term part of the yield curve. That's where the interest has been in the secondary market activity. T-bills, a second consecutive week whereby the bids that were placed were lower than the target amount by the CBK, that's 24 billion. So that the bids that were placed last week was 16.7 billion, which represented a performance rate of 69.6%, which was lower than the 80% that you saw in the previous week. Yields are still on a retreat, and comparing where they were around peak May 2021 peak levels, we've seen that on average they have declined something in the order of 1.22%. Of course, that's an average, but you can see that the 64-day T-bill has more or less a shed of 2%. 182-day T-bill around 1.5%, and then you find that on the 91-day T-bill is something lower than 0.5% decline from where they were in May 2021. And so far, 91-day T-bill, 182-day T-bills are below the benchmark rate 7%, whereas the 364-day is just 0.4% above the CBR rate at 7.43%. So that's the developments in the treasury bills market. But having said that, that's basically the function of the high liquidity that you've seen in the market, whereby because of the high liquidity, most bids, there's some aggressive or there's some undercutting in the T-bills segment. But we still, in our view, we think it's temporary, and this is and we could see a replay of even what happened last year around July levels, whereby once the T-bills bottomed, the only way was now an uptrend. So once we see a normalization in liquidity, we could now see the yields starting to take a gradual uptrend in the coming auction. So that's just our expectations. So getting on to the, some liquidity trends for the week, starting with the interbank market. We saw that the average rate declined negative 0.8% to an average of 3.28% over the terrain of last week. And this was also on low volumes that were executed within the interbank market. Another indicator that we usually track on a weekly basis is now the open market operations, whereby CBK comes and assesses the liquidity in the banking sector. And throughout the course of last week, it deployed what is called the term auction deposits through the 7-day, 14-day, 21 and 28-day term auction deposits. Collectively, I think they moved something in the order of 77 billion between all those tenors, and at different weighted average rates. For 7-day, 5.5%, for 14 days, 6.2%, for 21 days, 6.4%, and then for 28-day at 6.5%. Net domestic borrowing of government securities, this is basically just the treasury bills and T-bonds in the current financial year. So far, as per our calculation, is around 82.8 billion, and it's inclusive of the overdraft facility at the central bank. That's roughly 12.6% of the target in the whole of this financial year. So at this moment, it's ahead. The borrowing is slightly ahead of the curve, which is quite impressive at this point in time. So yes, another development that panned out last week in the corporate bond segment is now the final tranche of this Econ Green Bond. The Green Bond was first issued around August 2019, and then it was cross-listed in London Stock Exchange. That was around January 2020, thereabout. So initially, the target was 5 billion to be raised, with the issuer at least expecting a minimum of 2 billion. But the results for this auction, the first tranche in August 2019 was around 4.232 billion that was realized against a minimum of 2 billion. Obviously, the performance was supported by the guarantor, the 50% guarantee on this particular green bond. So that led to some confidence amongst the investors who came in to this particular issue. And then again, for the first issue and also this issue that was the results were announced last week, as compared to the family bank, which was open to the public, this particular green bond was now restricted to some of the sophisticated institutional investors. So that's why people just came and saw the results, that press release that came out last week. So, so the offer was looking at raising an additional 1.438 billion. So basically, the first 738 million was the balance from the previous issue, which fell short. That was the difference, because they were targeting 5 billion. They received 4.2 billion. So the 738 million was now the deficit from the first issue. And then there was an additional 700 million to be raised. So for an aggregate of 1.438 billion. The amount that was raised was 2.096 billion. So that represented a performance rate of 145%. And ideally, the coupon rate from the first issue was 12.25%. I haven't seen the numbers, but I suspect that coupon rate 12.25% is still applicable even with this current issue and the final tranche issue. The use of proceeds, so ideally this 1.438 billion is going towards what is called purpose-built student accommodation, PBSA. So with an additional bed capacity of 2,654. So that's where the use of proceeds from this green bond is supposed to geared towards. So, but ultimately, the ball game of the green bond is at least to get the initial funding and then to start this the PBSA up and running. And then ultimately, it's now to ensure that the quote unquote exit is now through real estate investment trusts. So far, we've seen Econ listing two REITs, real estate investment trust, in the unquoted securities platform, the USP, whereby we have a development rate which has something in the order of 211 million units that were issued at a price of 20 shillings a piece. And also the income rate has 215 million units that were issued, similarly at a price of 20 million. So, but now the target, if I think they are targeting institutional investors, the minimum amount that they are looking at is 6 million. So that works to 300,000 units. That if you are interested in this, either the D rate or the I rate, you are looking at a minimum investment of 6 million. So that by itself just tells us the sophistication of this particular issue, this particular USP, or the green bond, and also the exit or the D rate and the I rate from this Econ green bond. So that's just a snapshot of this particular issue, the Econ green bond, whose final tranche results were announced last week. So moving on to our week's trade, we are recommending an opportunity on the IFB1 2021-16. This issue was, this particular infrastructure bond was issued in January. It has a coupon rate of 12.26%, and we're looking at a price between 11.75% to 11.8%. Now, our investment thesis, we were comparing this particular paper against the 16-year paper that was issued in 2019. So ideally, we're looking at the papers that had an initial maturity of 16 years, the one that was issued in January, vis-a-vis the one that was issued in 2019. So the one that was issued in January, this IFB1 2021-16, it has a relatively higher coupon rate of 12.26% as compared to the one that was issued in 2019, which is around 11.75%. And then duration, just leave alone the jargon, but it boils down to the fact that it has a lower duration, 6.5 years, as compared to the one that was issued in 2019, which has 6.8 years. So ideally, if you think, just to break it down, this duration, what it means is that as an investor, if you are investing, if you're considering these two bonds, it will take you a shorter time to recoup back your investment. We are looking at 6.5 years in this particular paper, as compared to looking at the 2019 16-year paper, which has a slightly higher time frame. So ideally, our investment thesis is just on a comparison basis. If you are, as an investor, you are approached with two papers, which one is the more likely, which has the better prospects? So from our case, we are looking at the FB1 2021-16. The other issue is that this particular paper is paying its semi-coupon payment today. It was issued in January, I think it was 25th of January, or I don't remember the exact date, but 6 months as a bond pays coupon every 6 months, is semi-coupon payment is actually today. So it's been, today will not see trading on this particular bond, but tomorrow, once it starts the secondary market trading, the dirty price and the clean price will be more or less at par. We're looking at for every 100,000 that you have, you'll be investing 103,000, whether it's a clean price or a dirty price. So it's like it now resets before we start seeing accrued interest coming in. So what we are saying is that this week might be the ideal time for you to perhaps take advantage of this paper if you're looking at it, whereby the clean price, because it doesn't have accrued interest, it's semi-coupon payment is being paid today. It doesn't have accrued interest, or even if it has accrued interest, it will be quite negligible. So this is, it has an attractive entry point during the course of this week, more so from tomorrow's session. So that's it from my end. Let me invite my colleagues to walk us through the equity segment.
Thank you. Good morning to you. The markets closed the week last week relatively positive, as reflected by the uptick in the benchmark indices. The Nairobi All Share Index and NSE 20 were up 20 and 50 basis points week on week respectively. Volumes rose by 0.4% week on week to a turnover of 1.84 billion. On the gainers, we had Liberty, EA Portland, Transcentury and Unga, while NBV, Williamson T, Express and Captura T underspotting the week's laggards. It's a no-brainer per se, spotting Williamson T and Captura, given the book closure for the 10 shillings dividend was on Wednesday. On the foreign participation, we saw foreigners extending the dominance, accounting for 61.53% of the week's turnover. They had an overall net inflow position of 44.48 million and accumulated on Safaricom, while exiting on Equity Group, KCB Group, EABL and Stanchart. Also, BAT released their first half results on Thursday. That was on the 22nd, and they reported a 0.7% year-on-year rise in their earnings per share to 26.98 shillings, attributed to in part by a 19% year-on-year growth in net revenues to 12.5 billion, driven by the recovery of domestic sales volumes, exercise-led price increase, and sustained movement on export sales. Also, their total cost of operation and duties and tax increased by 27.2% year-on-year and 26.7% year-on-year, respectively, to 8.6 billion and 7.7 billion, respectively. The high cost of operation was driven by higher sale volumes, investments in portfolio transformation, and the pandemic-driven spending cuts in the 1H20. The counter's balance sheet shrunk 10.9% year-on-year to 19.3 billion, while profits before tax grew 5% year-on-year to 3.9 billion. The board also approved an interim dividend of 3 shillings and 50 cents to be paid on 16 September to shareholders on the register at the closure of business on 12th August. In this coming week, we expect Centum to release their full year results. That will be 27th, which is tomorrow. And a little recap on the past performance. The group's consolidated income for the 6 months period ended 30th September 2020 reduced from 6.6 billion to a loss of 1.7 billion compared to a similar period in the previous year. Also, the group held 6.5 billion in marketable securities and 1.7 billion in cash as at 30th September 2020. These are some of the expectations we have in light of the profit warning, Centum Real Estate results, and the past half-year results. Knowing the results of Centum Real Estate that reported a 58% year-on-year drop in the bottom line, the spotlight will be on private equity in light of the profit warning, which highlighted some of the companies in its portfolio reporting decline in net earnings that will obviously reflect in the overall group's earnings. Also, on the outlook, the portfolio recalibration against the Centum 4.0 weighting, and the spotlight here will be on the real estate, which according to last year's weighting, it was at 65%, and the allocation is to reduce to about 45 to 55% as in the targeted value. On Friday, we will be having EABL releasing their results. This will be in tandem with Safaricom's AGM. On this, we expect a very strong performance by mainstream spirits on the back of a downtrade from premium spirits due to the affordability, the easy offtake from convenience stores, supermarkets, and online shops, and a rising number of new consumers who opt to depart with spirits. We also project Tanzania will have a sustained revenue growth on the back of a relatively easy pandemic restriction compared to Kenya and Uganda. Also, over the past 4 years, Tanzania has reported strong performance. They reported 14% year-on-year growth in net sales in last year and a 20% year-on-year growth in the previous period. The sustained growth in Tanzania is driven by the revamped Serengeti brands with positive reception over the years, which posted 19% year-on-year growth in 2020 and 46% year-on-year in the previous year. With that said, we are waiting for the numbers because, as they say, numbers don't lie. On the peer review, the Nairobi All-Share Index outperformed its peers on a week-on-week median of 0.1. Its price to earnings was also above its African median of 11.5, while the dividend yield was below its African median of 5.2. On the corporate calendar, Safaricom's book closure for the 92 cents dividend a share will be on Friday, and the BAT new listed and the BAT dividend will have a book closure of 12th August 2021. To you, Melody.
Thank you, Wesley. So we'll have a look at the financial sector. So we've noticed that the rally over the past few weeks for the banking stock seems to have fizzled down, with most of the counters now closing marginally lower from where they started the week off, with the exception of NCBA that closed at 26.15 up from 25.65 at the start of the week. So the first update is that the government of Rwanda has approved the acquisition of Banque Populaire du Rwanda, that's BPR, by KCB Rwanda. So BPR is currently owned by Atlas Mara Limited. So KCB is also waiting for approval for Tanzania, where it's looking to acquire Africa Banking Corporation Tanzania, that's Bank ABC. So the total cost of these acquisitions is estimated to be at around 6 billion shillings. So after this acquisition and integration for KCB Rwanda and BPR, it's estimated that it will double its market share and become the second largest bank in the country. So this deal comes after Equity had called off its plan to acquire 4 banking subsidiaries from Atlas Mara, which they said was they decided to preserve their capital instead of acquiring these subsidiaries. So those stocks unfortunately fell through last year. So right as of the first quarter, 14% of the total profit before tax was generated by KCB subsidiaries. So the group is targeting around 20% in the short term. And after this acquisition of and integration of Bank ABC and BPR, the transaction is forecasted to add about 3 billion to the profit before tax. And it's also forecasted to contribute about 132 billion shillings to the balance sheet. So this will push KCB's group balance sheet past the 1 trillion shilling mark. So we've also seen that there's been an uptick in acquisitions and mergers transactions by Kenyan lenders in Kenya and in the region. So I&M acquired 90% of Orient Bank Uganda earlier this year. We saw Coop Bank also acquired Jamii Bora Bank, KCB acquired MBK. And I think we're going to continue seeing these transactions going forward. Also, we've seen now even Bank Misr, the Egyptian bank, want to come in CIB Bank last year acquired Mayfair Bank. So they're going to, looks like the surge in acquisitions and mergers is still going to continue. Also of note is that Equity had signed an $11 billion loan facility earlier this year with Africa Development Bank, which is supposed to support its commercial expansion throughout East and Central Africa, and also to serve as MSMEs. So we can hypothesize that there may be more acquisition transactions by Equity to come in the future. Secondly, the applications have begun for Bima Lab 2 InsurTech program. So this is where FSD Africa, the IRA, and Telastic Technology Services have set aside 5.3 billion shillings to support Kenyan innovators to develop initiatives to provide solutions to the insurance sector. So this comes after a successful pilot in January, where they had some companies like AI Care, Chamasure, and Sprout Insurance. So like for AI Care, they were using telematics and AI to give motorists accurate motor insurance risk assessments. So it improves underwriting efficiency and reduces the cost of premiums. Chamasure was another one that was creating peer-to-peer microfinance and savings platform, where you could save, where informal social groups like chamas can save for welfare support in case of deaths and accidents. Sprout Insure, it was developed for a faster claim processing for crop insurance, making it easier for farmers to buy policies. So as part of this program, Ray will collaborate with Ghana, Malawi, Nigeria, Rwanda, and Tanzania. Increased uptake of, as per the last IRG reports, around 3%. So Kenya's insurance sector has been suffering from largely a decline in profitability due to operational inefficiencies and manual processes. So we're seeing that this adoption in technology will assist insurers to increase like engagement and also to reduce their costs, to increase cost efficiencies and to also reduce the number of time taken between application and of the insurance policies. So some examples I've seen: UAP All Mutual is automating its medical claims interface. AAR is seeking to become a fully digital insurance company in partnership with Safaricom. Jubilee Health, it's in a collaboration with CarePay to roll out digital insurance on MTBA. Liberty Holdings, they have something called autocorrect, where you're given incentives for good driving habits, like you're rewarded for good driving habits. And so they have also integrated their systems with Association of Kenya Insurance, that's AKI, so that customers can get their digital certificates via email. So there's no need of visiting their offices, and also no need of multiple systems, just one straight through system. Thirdly, we've seen that the savings interest rate offered by banks gone down to around a 5-year low. So the latest CBK data shown it's dropped to about 2.55% in April, which is the lowest since August 2016, where it stood at about 1.68. So as Churchill had picked up earlier, so banks right now are cash rich. They don't really have a lot of pressure to get money from customers for onward lending. So banks have opted instead to have safety in government securities. So though this holding is declining marginally, it was at 51.25 in June from about 54.8% last year. Liquidity for the banking sector has also gone up 56.5% in April, which has been rising consistently from August 2020, which was at 53.2%. We've also seen that the amount of gross deposits has gone up while the gross loans has come down. Or rather, it was at 7.3% compared to 11.2% rise in deposits. So because of this single-digit growth, we've seen, as Churchill had mentioned earlier, the private sector credit growth was a bit slow at 7.1% in May, compared to 8.2% in May 2020. So one major issue that the 2020 survey on MSMEs access to credit, bank credit report by CBK found is that banks normally perceive MSMEs as risky
Hi, Churchill. Is it?
earnings and also the growth prospects as with the.
Hey, Melody.
Hello.
Hey, Melody. You're kind of breaking a little bit.
You can hear me?
Intermittently.
I continue?
Yeah, please try.
Sorry, my network is a bit unstable.
It's
okay. So
Churchill, we seem to have lost Melody.
Yeah. Okay. So we lost her, but she was doing some discussions around financial sector developments. So there's another update that she had from my end. I can just walk the participants through. Ideally, it's regards to the transactions around Standard Bank Group and also Liberty, because what was to be done actually, it's Liberty Holdings is meant to acquire. A couple of weeks back we saw that announcement, 24th of June rather, we saw that announcement by Liberty Holdings, which intended to buy out some 2 institutional investors. So when we did that math, it was coming to around 84 million shares, and that will ideally see an increase of the stake of Liberty Holdings in Liberty Kenya from 57% to 73.5% by that additional acquisition of 84 million shares. So far, that transaction hasn't been executed, but Liberty management told us that it will be done at the very latest first quarter of next year. And on the other side, we are seeing that Standard Bank Group, this is in SA, intends to acquire up to 100% stake in Liberty Holdings. So right now, Standard Bank Group has 54% stake in Liberty Holdings, but it wants to increase that stake to 100%. So Liberty Holdings will be a subsidiary of Standard Bank Group. So that's the board game. And what you've seen is that both boards of Standard Bank Group and Liberty Holdings in SA have already given the nod to this increased acquisition by Standard Bank Group in Liberty Holdings. So based on that, if it goes through, you could see that now Standard Bank Group will now be quote unquote indirectly having a larger stake in Liberty Kenya. And then if this Liberty Holdings acquisition of these additional shares, so you could see that Standard Bank Group will indirectly hold close to 73% stake in Liberty Kenya, but that's just the ball game we're looking at. And separately, also the other issue we're seeing is that Standard Bank Group, from a process that started all the way in July 2018, it had an intention of acquiring additional shares in Standard Holdings Kenya in the open market. So far, I think the stake of Standard Bank Group, the structure is that Standard Bank Group has has fully owned Standard Africa Holdings, and now Standard Africa Holdings has a 71% stake in Standard Holdings Kenya. So that directly tells us that Standard Bank Group, the parent group, has a 71% stake in Standard Bank Holdings. So based on the anticipated acquisitions, whereby they want to gradually increase this stake to 75% by an additional acquisition of 27.9 million shares. So that is what will lead to this attainment of just under 75%. The rule is that for an institutional investor or any investor which has a 75%, it might trigger a takeover request, takeover threshold. But that, I think CMA gave Standard Bank Group an exemption of this particular takeover trigger. So that's just basically our corporate structure, our thinking around what's happening in the Standard Bank Group and also the Liberty Holdings in the context of even their Kenyan operations. Finally, I think, I don't know, Wes can talk about this trade, Wes?
And even Melody is back. I can see her
okay.
about.
Oh, okay. So I don't know whether Wesley can talk about this.
Yeah, on our trading idea for the week, we recommend a hold on Safaricom PLC. We expect the counter price to be range bound in the near term as the book closure comes to a loom. That will be on Friday on their AGM. And also the M-Pesa revenues is expected to extend its stellar run of a voice in the current financial year with the lapse of zero-rated transaction and the new M-Pesa super app gaining traction among users. Also, M-Pesa, Safaricom's move of giving the users some privacy in the transaction is expected to come with some good investor reaction within the week. So that's our trading idea for the week. Thank you.
Okay, so back to you, Damaris. I don't know whether there are any questions.
No, today seems to be a very subdued day. Maybe guys were just absorbing a lot of the information you shared, but we don't have any questions at the moment.
Damaris, you've forgotten.
Oh God, what have I forgotten?
Today is the 26th of July and you've forgotten.
There's a lot of things that happen. What's special about the 26th?
I remember vividly, 26th of July, 2 years ago, because I put a calendar alert, actually it reminded me today, of the water dispenser conversation we had, where you came and accused analysts being in the same WhatsApp group with sorcerers, witches, astrologers. You remember that conversation 2 years ago? Actually remembered, so it even alerted me today. And I think from that conversation is when it led us to the Genghis predictions that we have, how that you lumped us in the same group with sorcerers. So what we've been having is the Genghis predictions in our playbook. It started not this year, but in 2020, we had our Genghis prediction. So actually you can see what you've spotlighted there, number 4. How many corporate bonds will be issued this year? And then we went out on our limb and then we say we project 2 corporate bonds listings in 2021. How many have we done today, this year?
I can recall 1 so far. Where is the second one?
Family Bank. There's Family Bank and then there's this Econ Green Bond.
Ah, okay. But you know, Churchill, technically speaking, it's just July.
well, but at least if the year ends today, I mean, we met that target. And then the other one is about the Tokyo Olympics, whereby it was still skewed in uncertainty. And then we came out and then we say it will be held between either July and August. And here we are. Olympics started last week on Friday. Okay. And then for last year, I think we predicted that Kenya will bag how many gold medals? We said 7. So this is something we'll see panning out, whether Kenya will ideally bag the 7 medals, but this is now our analysts being in the same WhatsApp group as astrologers, what you made us become. But now, because we ideally look at the the brighter side of life, the glass is half full side as opposed to the glass is half empty, we decided to take it in good stride. So here we are. We hope our predictions will be spot on.
We hope so. I will definitely note those 7 gold medals and we will discuss them in August.
Please do not. It's just that we...
Literally the only thing I'm taking away from today's session. But we have 4 other questions that have popped up. We have Kamal who's asking a couple of questions. One, he says that COP Bank received World Bank billions for SMEs and it bought Jamii Bora Bank. It has a mortgage-linked pension product and its CEO was the only listed banker to get a bonus. I saw that amount. So Kamal is curious, why with all these things happening, why is the share price still falling? That's a very fair question. The second question he has is, should an investor accumulate centum in view of the future performance that is anticipated? And lastly, he would like to know your view of the Fahari Stanley Bright as a counter. I'm loving these questions. So we can start with COP Bank. Why is the share price falling in spite of all these accolades?
I can try that one. Because we've seen right now that all banking stocks have the rally that they've been witnessing has kind of fizzled out. And so now the foreign investors, we've seen that they're exiting from these counters and COP is one of them. So usually these foreign investors have an investment policy statement that dictates how many shares they can hold of a certain company. So if it goes above a certain price, you'll find that they'll sell off. So that could be one of the reasons why the price is falling at the moment. Also just capital appreciation, because it's been going up. They maybe had a certain stop loss that they put for the price and now they're selling it off. The other issue as well is because of this increasing Delta variant cases, maybe these investors are seeing that our market is becoming more high risk, you can say, the emerging market. So they want to remove their funds to take it to safer jurisdictions, you would say. But mostly it could be just that it's the investment policy statements. They have a certain percentage of a stock that they can hold. If it crosses a certain price, they have to reduce and sell off. That's my opinion.
All right. I definitely think I caught that part, although you broke a bit towards the end. So we're basically saying it's the activities of our institutional investors affecting the price.
Yes, more or less the foreign investors.
Okay. All right. Thank you for that. How about the second part to Kamal's question? Should an investor accumulate centum in view of the future performance of the counter?
Let me try answer that one. The management views the business performance to reflect at least 25% lower earnings in this year compared to the previous financial year. So based on your personal analysis and projections that you may have made, if you see it fit as a relatively good performance, the market will always reward you for being fast with that move. But if you have some doubts, there is a rule that always says, when in doubt, remember rule number 2, which rule number 2 is always fiercely protect your capital. So that's based on your view on how the results will affect the market.
Okay. Well, I have now a lot of questions now for COP and centum, especially Wesley, that's the second response you've given. I think my question for COP, if the price is falling because of foreign, institutional investor activity, does it mean that if I was an investor looking for opportunity, I should still continue accumulating the stock, especially if the price is plummeting? Are we given a buy recommendation? And that centum perspective, Wesley, I'm not sure. It gave me free rein to decide whether I wanted to actually accumulate the counter? I'm not entirely sure.
Yeah, the question was solely based on the performance, how the performance should you accumulate in the because the performance is soon coming. Well, so far we know that for a while investors were speculating or bearish about the counter because of the 25%, at least 25% reduced earnings that was announced in the profit warning, but they released their real estate results. It had a 58% decrease in the bottom in its bottom line. So the spotlight here will in a big way be on the private equity, because some of the listed companies there really reported not so good performance. But on the overall perspective, there is the marketable securities in the portfolio, so which might have an improved performance. So on a holistic view, different investors will have different perspective, because some will always be bearish about our perspective and the others not so bearish. But on the event that the results will not be as bad as people expect it to be, the market will always reward you for being fast with that view.
Or if I may jump in, ideally, the crux of the profit warning is comparing even the previous financial year, the year ending March 2020. It's reported that it had a one-off gain, which is not reflected in the current financial year. And because of it had real estate holdings, and because of the COVID-19 fallout, it had a negative impact on its real estate holdings. So that is now the crux of the profit warning announcement. But looking at the future performance, Centum is private equity, so it gets into some of these companies here and there. But now perhaps the worry has been, and what has been priced in. Whenever we talk about Centum, we talk about its low price to book ratio. Price to book ratio in the sense that its current price as a percentage of its book per share is quite low. I think we're looking at 0.2. Yet Centum states that its net asset value should price it around 75 shillings, as opposed to where it is below 20 shillings per share. So based on the current pricing, the market obviously has been giving it some discounts, because what we've been seeing with Centum, it's a case of selling off winners and retaining the losers, as opposed to the other way around, whereby you stick with the winners so that you can be able to harness earnings growth moving forward, as opposed to selling them quickly and then retaining some businesses or some underlying businesses which might take longer time for Centum to realize positive earnings growth going forward. So that is what is still up in the clouds from an investor perspective, and it will also dent even the future performance. So that boils down to Centum in regards to the future performance. So from a perspective, or once investors are convinced that Centum will get into some high-yielding sectors, or whereby the growth for the underlying companies might grow faster than even the average sector. So that is, at that point, you can see investors starting to reward it. But at this moment, the narrative is still quite clouded in regards to the underlying companies that will propel Centum positive growth momentum.
All right, Rachel, thanks for that comprehensive answer. Perhaps we can tackle the final aspect, which was our view on Fahari Stanley Bright as a counter.
Actually, the name is iLab. ICA, because Fahari was now, it was bought by now ICA, from Stanbic now to ICA. So it's iLab, iWrite. But at the moment, we'll have to do some much more diligence on that. But the prospects are quite more resounding as compared to where by the time they were releasing their full year 20 results. In the context that it had an anchor tenant, think about the iRight getting some income from different properties around the city. There's the Greenspan Mall, which is the biggest, and then we have some other commercial properties, I think in Lavington, another one, I think in the Westlands area. So the biggest one, and which also was detrimental to iRight, was now the Greenspan property. And because of the anchor tenant there was Tuskys, and we all know how the retail market has been. But now there's been a change in the anchor tenant. I think it's Naivas. I think it's Naivas now coming to occupy Greenspan Mall, unless I'm wrong. So based on that, at least the prospects of even iRight is much more better as compared to a year ago or a year and a half ago. So from that perspective, it could be attractive entry levels. In terms of the pricing, we'll have to do some due diligence, and then we can be able to comprehensively answer that. But from a fundamental perspective, I think there's an improvement in the fundamentals, at least in their key risk portfolio. That's the Greenspan Mall.
All right then, thank you, Churchill. Alphonse wanted to know our take on the KPLC stock.
Well, let me take that quickly. KPLC is still a speculative trade in our portfolio. We don't have a recommendation on that. I think with KPLC is just the high costs that we've been seeing, in which has been detrimental even in their earnings going forward. Last financial year, I think for full year 20, that's the latest that you've seen for KPLC results. It was in the red, and you can wonder how a monopoly is deep in the red in terms of its losses. But that said, and in the context of the reforms that we're looking at, be it on the IMF side, whereby they have really this from Treasury side, that they want to look at the parastatals that poses the largest fiscal risk. KPLC stopped there as one of the losses, together with Kenya Airways. So there's some reforms that Treasury has anticipated that they need to bring on board to bring some efficiency gains in KPLC. So that's one facet of it. On the other side, we are seeing also the World Bank facility, the H2 billion that was extended to Kenya end of mid-June. One of the conditions also was on fiscal reforms in some parastatals, again, KPLC there. But then for the World Bank, they're looking at this, the IPPs, independent power producers, whereby they have expensive tariffs, and then they are proposing ways of even moving away from these IPP models, whereby KPLC finds itself at it doesn't have bargaining power, whereby the IPPs, the independent power producers, they produce power and then they take it to KPLC. So either KPLC takes it or they repay the IPPs, and then the tariffs that KPLC ends up paying the IPPs is quite exorbitant. So there's a way that World Bank has proposed that going forward, they need to relook at these IPPs and then move away from these feed-in tariffs. That is the model adopted, the IPPs, and then go to a better competitively priced system. So from if these two legs, from the IMF's perspective and then from the World Bank's perspective, are properly fine-tuned, and then we see that the government sees through these proposals, we could see some increased efficiency gains in KPLC, which will also improve its fundamentals. So right now it's still a wait and see to see whether the management of KPLC will be able to see some improved efficiencies, which will reduce its losses and see it much more it's operating better going forward. So that's just the narrative around KPLC. But at the moment, we don't have any particular trade on KPLC.
All right, then. Thank you for that comprehensive answer, Churchill. Ian Wangai has two questions. The first is that with the news of M-Pesa spin-off, I think he means M-Pesa becoming its own entity. Is this going to affect the company? I think he means Safaricom in general. Secondly, is asking, is there a difference between a stock and a company? Can a stock do well while the company does badly, or vice versa? So, who is going to tackle this? Wesley?
Yeah, let me deal with Ian's question. Those are two good questions. The first one, how a news about the M-Pesa spin-off going to affect the company. Well, if it's addressing M-Pesa, the joint venture of M-Pesa and Vodafone, then that is a positive tweet because they acquired the M-Pesa brand from Vodacom. But in the event that this question means that M-Pesa being spin off as a separate business to the voice and to the telco business, then it depends on whether this move will come as a business initiative move from the company or as a regulative move. On the event that it will be a regulative move and the company's stand is that the two businesses operate better and in synergy when they are a single unit, then it will have a negative investor perspective because the management has a different view on the regulator's move. But in the event that it will, the move will be initiated by the company itself in spinning off M-Pesa as a separate business and the telco business separate business, then investors will have confidence because they'll trust in the management's view and perspective for future for the future in the event that the spin-off is done. Also, on the second question, yes, there is a difference between a stock and a company because a stock basically is a single unit of a company that is sold to generate capital. So when a stock will reflect the performance of a company, except on the investor speculation on here and there news. But generally, it will always reflect the performance of a company. When a company performs well, the stocks will always rise in that performance and it will reflect the performance. And the vice versa is also true. To you, Damaris.
All right, thank you so much, Wesley. That was very clear. We appreciate that. The next question on the list is from Michael. He asked, does the entry of foreign lenders signal some hope for increased lending to the private sector, or are they likely to favor government securities instead?
I'll try and tackle this one. So in my view, I feel that these foreign lenders have come to Kenya because they've seen an opportunity in this region. So it's highly unlikely that they'll invest in government securities because they came here to see how they can grow their portfolio and also increase trades, like we've seen with the CIB commercial, the bank from Egypt. They acquired Mayfair Bank so that they can be able to get into the trade finance business and also give credit facilities to Egyptian corporates that work in Kenya and in the region. So they're also looking into going into mortgage, to giving mortgage into the mortgage sector, more or less. You can hear me?
Yes.
Yes, so I think they came into this market because they had cited some pockets of opportunity. So it's unlikely that they'll go into government securities.
Okay, thank you for that.
That
Was clear. All right. The other question is from Eric. Eric asks, the FTSE 25 index declined each day last week. What was the reason for the drop and what's the outlook for the index this week? Do you guys track the different indices?
Let me take that one. For the FTSE and NSE index, for the 25 one, this is basically tracking the major liquid stocks in the bulls. So thinking of your typical Safaricom, Equity, KCB, and and some of the other stocks, EABL, whatever. So based on that, the underlying companies, I think apart from Safaricom was a bit muted last week. If you get into the individual names, you can be able to drill down and see which specific counter or which specific counters led to the overall decline in the FTSE and NSE Kenya 25 index. That said, we haven't analyzed such to comprehensively respond to Eric, but we can be able to do that. I can find ways of engaging Eric even outside the context of this call, so as to be able to better answer Eric's question.
Okay, so Churchill, you know Eric.
Eric knows me.
Okay, enough said.
We know each other. We know each other.
All right. John's question. John is asking whether the NBV share will continue rising as witnessed in the past fortnight.
Well, NBV is a very interesting counter. It has had a stellar run for at least 3 weeks, closing in the top movers. I think the last week it closed at 12.4, being the top mover, and in this week it was the top loser when it shared 17.26% in share value. By now, I guess the market has priced in the news on expansion. Unless any further news come up, then on something that investors can speculate on, or further information on the expansion and the acquiring of all these ventures from the cement manufacturing, heavy construction, repairs, and the airline servicing. When more information comes out on how the approval goes, then investors might have something more to speculate on. But as far as it is right now, it seems the market has priced in the news.
All right, thank you for that. I have a final question from Ian. So Ian was, he noted this. Just an opinion, maybe we could have a discussion on how one can exit positions and get capital gains. The general narrative has always been to buy shares and not a follow through in how one gets a gain or an advantage from the positions, maybe other than earning of dividends. An example he gives now is this NBV counter you're discussing. Case in example with the current NBV counter, guys are trying to get out, but they are facing liquidity issues. So I think if I got Ian's questions correct, is like, other than just the buy, sell, hold recommendations, could we have discussions on how people can exit positions and make capital gains, of course, if the share price has appreciated? So what's your take on this kind of discussion? We can start with Churchill.
That's a great question, Ian, that you brought in, and it ideally makes sense in terms of portfolio management kind of a framework. But the context that so far we've been doing is in terms of giving some trade recommendations, but that's a great idea. But in that line, and in this whole portfolio framework, we are perhaps looking at a point in time whereby we are assuming that all investors, perhaps they are new investors, looking at opportunities in the NSE, and then we can say, okay, buy A, B, C, D stocks. And then after 3 months, we can now revisit even whether they have climbed or they have, what's their upside or what's their performance. And then based on that is when we can be able to comprehensively say, sell this and that. We are also cognizant because of the heterogeneity of investors. Say an investor who bought NBV in November or before it was suspended. Remember, like a stock like NBV sorry, was suspended. And then after the lifting of the suspension, we saw the price skyrocketing to where it is. I think at some point we're looking at it has had an investor gotten in during its low pricing. We are seeing a returns of 1,000% between December up until right now, just based on that meteoric rise in NBV share. But you find that that person has accumulated wealth or has gained much more, as opposed to somebody who came in NBV stock, say 2 weeks ago at this current high levels. So you'll be speaking to two different investors. One has already made like 1,000 return. One is 5% and stuck out on how to get out. So I think you're giving us some ideas in terms of even coming up with some portfolio framework, whereby you can just give, okay, in these national portfolios, if you had entered this, or we tell people, okay, buy these 3 stocks, and then after 3 months, you'll be able to say gain 25%. So if you are 25% or 20% within, you can tell people to exit or something like that. So that's the only route I can see of even incorporating sell at this certain price. But nonetheless, that's a valid question you raised.
And I love your response, Churchill, to Ian, because it makes a lot of sense. At any point in time, you have investors who started their investment in a particular time at different points in time. So for someone, I'm impressed that it's 1,000% return. I almost wish we were allowed ourselves personally to trade, but that is incredible. But then there's a guy who joined the particular counter 2 weeks ago. So the kind of gains he's starting to get is not going to be the same as the guy for last year. So I can appreciate the complexities of that. And I think our attendees can also appreciate that. And it also makes sense why at any particular Monday or week, we just look at this point in time for this counter. Is it great to exit, to enter, or just to hold your position? That makes brilliant sense. You see, Churchill, sometimes we can vibe, and I totally get you.
But we do.
Sometimes you go off on a tangent. Okay, I think to wrap up today's session, let's handle Belinda's question, which she sent on chat. Belinda just wanted a brief, and I emphasize brief, a brief commentary on the I&M stock as well as Kenya Re. And then on that particular point, we can conclude. So I&M and Kenya Re.
I can try and tackle this one. So for Kenya Re, in our aspect, it's buy. It's so that the counter has been trading at a deep discount. Actually, it's been at 0.81. That just goes to show how discounted it is. It also has a relatively high dividend payout ratio of 7.9%, whereby most insurance companies were not paying dividends. It's also the national reinsurer for the country, and it has a significant government stake. So that gives us an outlook that it may continue paying dividends in the future. It was also looking into going into the Egyptian market as well. So you can see it's also looking to diversify its earnings profits. And also there's a time it had talk of selling its Kisumu Plaza for 3 billion. So let's wait and see how that goes. I think they wanted to get out of the real estate sector. For I&M, remember they had recently done the bonus share issue. So for that one, we haven't really gotten the target price per se. So I'll just comment top level about the company. So we saw it launched a wealth management arm recently. So as it looks to diversify its income. It also acquired 90% of the Orient Bank earlier this year in Uganda. So we've seen also that's another aim to increase its market share and its capital, its customer base as well. So this regional diversification we're waiting to see how it plays out to the company. but briefly, that's what I have on the two stocks.
Okay, that's fantastic, Melody. Thank you. Is there anyone else who would like to enrich that, or can we call this a wrap?
I'm okay.
Okay. All right. Thank you so much, team. Thank you, Melody, Wesley, and Churchill. I think we've had a very interactive session. We really appreciate the time you've taken. Thank you, attendees, for attending our Monday session. As usual, the video will be uploaded to the Genghis YouTube channel in case you missed any part. If you're not Eric, if you're like everyone else who doesn't know Churchill, you can reach us through social media. We are on all the platforms and we're very reactive. In case you have any questions or concerns, or you feel like you needed more of a conversation, we're also available on email. You can email research@genghis-capital.com or even marketing@genghis-capital.com. We are also very responsive on email. So thanks, have a great week ahead, and let's meet next month. I know that's a lame joke, but I just wanted to say let's meet next month. Let's meet in August. You guys have an awesome week. All the best. Bye.